There is a moment in every investor's life when a question gnaws quietly, almost imperceptibly at first, and then suddenly grows loud enough to demand attention. What if the excitement that surrounds artificial intelligence, the dazzling headlines, the soaring valuations, the stories of overnight fortunes, is nothing more than a reflection of human hope rather than an indicator of lasting value? Warren Buffett, a man whose calm demeanor and decades-long mastery of financial markets have guided countless fortunes, has issued a warning that echoes through the corridors of modern investing. The AI bubble could be far larger than the dot-com frenzy of the late 1990s. But what does that truly mean? And why should anyone concerned with their financial future pay heed to it? Consider the dot-com era for a moment. Investors were swept away by the promise of the internet, imagining a future in which traditional business models were rendered obsolete overnight. Companies without profits, without meaningful revenue streams, were valued in the billions simply because their names ended with com. The frenzy was intoxicating, and for a while, it felt as though everyone who wasn't investing was missing out. Yet when the bubble burst, the illusion of inevitability shattered, and many fortunes vanished into the void. Buffett's caution now suggests that we may be witnessing a similar pattern with AI, one that could dwarf the spectacle of those heady dot-com years. But unlike the internet, which fundamentally changed communication and commerce over time, AI promises something even more abstract: the potential to replicate intelligence itself, a concept that is thrilling but difficult to measure, difficult to regulate, and difficult to value. The question, then, is not simply whether AI has transformative power. It almost certainly does. The question is whether the valuations, the investment enthusiasm, and the relentless media attention are grounded in sustainable economics, or whether they are being inflated by the same human behaviors that have driven past financial manias. How do we separate the meaningful advances from the glittering hype? How do we distinguish between the companies that will genuinely create lasting value and the ones that exist primarily to feed the illusion of growth? It is here that Buffett's wisdom offers both clarity and discomfort. He does not chase fads. He does not succumb to the noise of the crowd. Instead, he observes, he measures, and he warns. And in the case of AI, the warning is subtle yet urgent. Technology that can mesmerize with its promise may also blind investors to the fragile foundations upon which it is built. To understand why, we need to step back, peel away the layers of excitement, and examine AI as both a technological marvel and a market phenomenon. Artificial intelligence, in its modern form, is the product of decades of incremental progress, breakthroughs in computing power, algorithmic refinement, and massive amounts of data. It is, in essence, a mirror of human thought distilled into patterns and predictions, capable of performing tasks once thought the exclusive domain of human intelligence. But here lies the paradox. The more capable AI becomes, the more it is treated not merely as a tool, but as a vessel of expectation. And expectations, as every experienced investor knows, are the most volatile commodity in the financial world. When expectations outpace reality, markets begin to price in dreams rather than tangible outcomes, and the result can be a dangerous divergence between perceived value and actual value. Let us pause for a moment to consider the psychology at play. Humans are by nature drawn to novelty and potential. We are wired to imagine what could be, and in doing so, we often overlook what is. The dot-com bubble thrived on this very tendency. Investors were captivated by the idea of endless growth, forgetting to ask fundamental questions about profit margins, sustainability, and intrinsic value. Today, AI commands a similar allure. Headlines promise exponential returns, venture capital flows like a river with no dam, and startup valuations climb into the billions before they have ever proven their ability to generate sustainable earnings. The excitement is palpable, and yet the calm voice of reason, the kind that Buffett embodies, reminds us that a bubble is not a question of possibility, but of proportion. It is not about whether AI can change the world. It is about whether the current pricing reflects genuine value or simply the fevered imagination of investors caught in a tide of collective optimism. And so the suspense begins. We are left with a series of unnerving questions. How far can this market rise before gravity asserts itself? How long can the enthusiasm of investors mask the underlying weaknesses in business models, in scalability, and in regulatory frameworks? And most importantly, when the inevitable correction comes, who will be left holding assets whose value was never grounded in reality to begin with? These are not questions that can be answered with certainty, but they are questions that demand reflection. They demand a calm, measured approach, the kind that refuses to be swept away by the drama of the moment. It is precisely here that the analogy to the dot-com era becomes instructive. Imagine, if you will, a vast garden of technology startups, each plant nourished by investor capital rather than by proven profitability. Some of these plants are sturdy and well-rooted, capable of weathering storms and growing over decades. Others are fragile, designed to bloom spectacularly for a season and then wither when conditions change. In the dot-com bubble, the market was filled with both types, yet the frenzy did not discriminate. Today, in the AI landscape, we find a similar garden, vast, promising, and yet potentially treacherous. Recognizing which investments are perennials and which are annuals is a task that requires not just insight, but discipline and patience. And so, as we stand at the edge of this new frontier, it is worth reflecting on the lessons of history, the psychology of markets, and the quiet, authoritative guidance of those who have navigated bubbles before. Buffett's warning is not a prediction of doom, nor is it a denial of the incredible potential AI holds. It is rather a call for prudence, for measured evaluation, and for the recognition that human behavior, our hopes, fears, and herd instincts, remains the ultimate driver of market dynamics. The excitement is undeniable, the potential vast, but the risks are real, and they are already taking shape in subtle, almost invisible ways. In the next part, we will delve deeper into the historical parallels, examining past manias and collapses to illuminate the patterns that repeat across decades and the subtle psychological forces that transform technological promise into speculative frenzy. You will explore the mechanisms that turn rational optimism into reckless exuberance and consider how AI, with all its complexity and allure, may be dancing dangerously close to the same precipice that once claimed fortunes during the dot-com era. But before we proceed, let the question linger in the back of your mind. Are we witnessing the dawn of unprecedented technological revolution, or the quiet formation of a bubble that could rival or even exceed the spectacles of the past? To truly understand the present moment, it is often instructive to glance backward, to study the echoes of history and the patterns that emerge when human ambition meets financial speculation. The dot-com era, which now feels both distant and immediate, was not the first time investors succumbed to the intoxicating allure of novelty. From the Dutch tulip mania of the 1630s to the South Sea bubble of the 1720s, markets have repeatedly demonstrated a remarkable susceptibility to collective enthusiasm, a willingness to price dreams rather than reality, and a persistent tendency to mistake short-term excitement for long-term value. Each of these episodes carries its own unique context, yet the psychological undercurrents, the fear of missing out, the herd mentality, the seductive promise of rapid wealth, remain strikingly consistent. In the 1990s, the internet was a vast, uncharted frontier. Investors gazed at its limitless potential with a mix of awe and hunger, often ignoring fundamental questions about business viability. Companies without profits were celebrated, and stories of overnight millionaires dominated headlines. When the bubble ultimately burst, it was not the technology itself that failed. The internet reshaped the global economy in profound ways, but the fevered valuations and speculative frenzy that had detached from reality. The lesson is subtle yet enduring. Innovation alone does not justify price. It is the relationship between potential and valuation, between promise and execution, that determines the durability of wealth. Now consider AI. It is tempting to compare it to the internet in its early days, but the comparison only partially holds. The internet transformed access to information, commerce, and communication, tangible systems with measurable outcomes. AI, in contrast, operates in a space of abstraction, capable of performing intellectual tasks modeling human behavior, and even generating content. Its capabilities inspire awe, but they also invite a different kind of speculation, one that is less anchored in revenue and more in expectation. The valuations of AI startups, fueled by venture capital and media hype, can become untethered from the economic realities of the companies themselves. And when reality and expectation diverge too sharply, markets have a way of correcting with brutal efficiency. The human element in this story cannot be overstated. Markets are not merely mechanisms of trade, they are reflections of human psychology. Optimism and fear, pride and panic, curiosity and greed all converge in a complex dance that shapes asset prices. In periods of rapid technological change, these forces become magnified. Investors may look at AI and see limitless opportunity, yet the excitement often blinds them to the vulnerabilities that lie beneath the surface. Reliance on untested business models, regulatory uncertainties, and technological limitations that are not immediately apparent. This is the subtle danger that Buffett alludes to, a warning not against innovation itself, but against the collective amplification of human expectation. Consider a metaphor. Imagine a high-speed train barreling down a track, carrying passengers who are mesmerized by the scenery flashing past. Some passengers are seasoned travelers, reading maps, understanding schedules, and aware of potential hazards along the route. Others are swept up in the thrill, leaning out of the windows, imagining themselves on a journey of unbounded adventure. The train may travel far and fast, but the thrill alone does not guarantee a safe arrival. Bubbles often form when the excitement of the journey overshadows the rational evaluation of risk. AI, in this metaphor, is both the engine and the scenery, breathtaking in its potential, but carrying passengers who may not fully understand the terrain ahead. The question becomes, what drives this enthusiasm, and why does it so often lead to overvaluation? Part of the answer lies in the mechanics of human cognition. We are pattern-seeking creatures, drawn to stories that simplify complexity. AI offers stories of instantaneous innovation, of intelligence captured in code, of wealth created seemingly from nothing. These narratives are compelling precisely because they are easy to grasp, even as the underlying systems are intricate and opaque. The danger arises when the story begins to dominate the analysis, when the myth of inevitability overtakes careful examination of fundamentals. Another factor is social proof. When everyone around us is investing, when the media amplifies the excitement, and when early adopters boast of extraordinary gains, it becomes increasingly difficult to maintain a contrarian perspective. Even the most disciplined investors may feel the subtle tug of conformity, questioning their caution in the face of apparent opportunity. History teaches us that the moments immediately preceding market corrections are often marked not by dramatic events, but by a quiet, pervasive belief in the permanence of trends, a belief that, in retrospect, appears tragically naive. Yet it is not all doom and gloom. The presence of excitement, speculation, and even overvaluation does not inherently condemn an industry or technology. The internet recovered, matured, and created enormous wealth for patient investors. The key lies in discernment, understanding which opportunities are grounded in sustainable value and which exist primarily to feed a collective dream. Buffett's guidance, as always, emphasizes patience, skepticism, and a focus on intrinsic worth. He reminds us that markets may remain irrational longer than we expect, but over the long term, value asserts itself. Investors who recognize the difference between hype and substance are better positioned to navigate both the exhilaration and the turbulence of emerging technologies. As AI continues to evolve, these lessons become increasingly relevant. The pace of innovation is rapid, the headlines unrelenting, and the allure of immediate gains powerful. Yet the structural realities, profitability, scalability, regulatory frameworks, and technological limitations remain constants that cannot be ignored. The risk is not in acknowledging AI's potential, but in allowing expectation to outpace reality, in mistaking excitement for value, and in becoming a passenger on a high-speed train whose final destination is uncertain. In the next part, we will explore the structural and technological vulnerabilities inherent in AI, examining the regulatory, operational, and market risks that investors often overlook. We will also dive deeper into the psychological mechanisms, fear, greed, herd mentality, that amplify bubbles and drive volatility, highlighting how these forces may already be shaping the AI investment landscape. And as we continue, we will begin to see why Buffett's calm, disciplined perspective offers not just guidance, but a framework for navigating uncertainty in a world captivated by the promise of tomorrow. As we consider the unfolding AI phenomenon, it is crucial to confront the structural realities that underpin this dazzling landscape. Beneath the headlines of billions in funding and valuations that defy conventional logic, lie subtle but significant vulnerabilities, fragilities that are often invisible to the casual observer swept up in excitement. Technology, as powerful as it may be, is not invincible. Algorithms can fail, systems can be manipulated, and even the most sophisticated AI models are only as reliable as the data and architecture that support them. Investors, in their rush to embrace the future, may overlook these quiet risks, lulled into a false sense of inevitability by the sheer spectacle of progress. One of the most pressing risks is regulatory exposure. AI operates in a gray zone, one where innovation often outpaces legislation. Governments are scrambling to understand the implications of technologies that can generate content, influence behavior, and even make autonomous decisions. Today, there may be little oversight. Tomorrow, sweeping regulations could reshape the market overnight. History offers countless examples where regulation has punctured speculative bubbles, and AI is unlikely to be immune. Companies that appear untouchable today may find themselves constrained by compliance requirements, liability concerns, or legal challenges that were previously unimaginable. It is a reminder that no matter how transformative a technology may be, it remains subject to the societal frameworks that govern its use. Equally important are operational risks. AI models, while sophisticated, are not perfect. They are prone to biases embedded in their training data, errors in execution, and vulnerabilities that malicious actors can exploit. A single flaw or failure can have disproportionate consequences, not only for the company in question, but for investor confidence across the entire sector. Unlike traditional industries, where failures are often incremental and localized, technological failures can propagate rapidly, magnifying the impact of even minor miscalculations. The faster and more interconnected the market becomes, the greater the potential for cascading disruptions, a structural risk that is difficult to quantify yet impossible to ignore. And then there is the market risk itself, the intangible yet palpable force that drives bubbles. Investors are not purely rational actors, they are creatures of emotion, susceptible to fear and greed, to herd behavior, and to the seductive allure of the next big thing. The AI market, with its headlines of staggering valuations and stories of rapid wealth creation, amplifies these tendencies. Even seasoned investors can find themselves swept up in collective optimism, mistaking momentum for validation. The paradox is that while AI may indeed revolutionize industries, the market's enthusiasm often outpaces the actual pace of innovation, creating a widening gap between perception and reality. This is the essence of a bubble, a phenomenon fueled as much by human psychology as by technological potential. To understand this dynamic more vividly, consider a river flowing toward a dam. The current represents the collective excitement and capital rushing into AI ventures, a force that can lift all boats in the short term. Yet the dam, the limits of reality, regulation, profitability, and execution, remains. When the river encounters resistance, the energy does not disappear. It can overflow, spill, and reshape the landscape in unpredictable ways. Investors who fail to anticipate the dam's constraints may find themselves caught in the torrent, swept away by forces beyond their control. The most valuable insight, therefore, is to recognize where the current is strongest, where the banks are weakest, and where the energy of human expectation may outpace the terrain's capacity to support it. Psychologically, this is where fear and greed intertwine in the most potent forms. Greed propels investors to chase rapid gains, often at the expense of caution. Fear, in turn, emerges subtly, lurking in the margins, amplifying anxiety when the first signs of correction appear. Herd mentality can dominate, as individuals look to their peers for cues, believing that collective behavior signals certainty. The result is a market that can swing wildly, driven less by fundamentals than by perception, rumor, and sentiment. AI, in its abstract brilliance, magnifies these forces, because the promise of intelligence itself taps directly into our imagination, our desire to be part of something epochal, to participate in a revolution that feels inevitable. Yet there is a deeper layer, a subtle cognitive bias that often goes unnoticed. Investors are prone to overestimating the near-term capabilities of AI while underestimating the long-term challenges. We tend to extrapolate current trends linearly, assuming that growth today guarantees success tomorrow, but technology rarely unfolds in a straight line. Setbacks, unforeseen limitations, and unforeseen costs inevitably arise. The excitement of rapid advancements can blind us to these realities, creating an illusion of unstoppable progress. In such an environment, valuations can become untethered, rising far above what the underlying business models can realistically support. History shows that when the market finally reconciles expectation with reality, the correction can be swift and unforgiving. This is why Buffett's caution carries such weight. He does not dismiss innovation, nor does he condemn enthusiasm. He simply asks a fundamental question: is the investment grounded in value, or is it fueled primarily by expectation? Intrinsic value, in Buffett's terms, is not a fleeting number in a spreadsheet or a headline on a website. It is the ability of a business to generate sustainable earnings, to withstand volatility, and to create wealth over the long term. AI companies that have not yet proven this resilience may still offer extraordinary potential, but they also carry extraordinary risk, a risk that is magnified when investors fail to distinguish between speculation and substantive value creation. And so, as we survey the AI landscape, the dual forces of potential and vulnerability become clear. The promise of AI is undeniable, its potential to transform industries, augment human capability, and create new paradigms is staggering. Yet within that promise lies a quiet tension, a structural fragility that may be invisible until tested. Investors must navigate not only technological uncertainty, but psychological complexity, recognizing that markets are shaped as much by emotion and perception as by the realities of code, capital, and computation. Those who succeed are likely to be the ones who balance optimism with skepticism, who pursue innovation while respecting the immutable laws of economics, who embrace progress without surrendering prudence. In the next part, we will move deeper into Buffett's perspective on navigating uncertainty, focusing on strategies for long-term investment, the virtues of patience, and the ways in which disciplined reasoning can protect wealth even amid speculative frenzies. We will also explore case studies from history examining investors who thrived in bubbles and those who faltered, to extract lessons that are as relevant to AI today as they were to the markets of the past. The narrative is building toward clarity. Excitement and risk are inseparable, but wisdom lies in knowing where to place your bets, how to measure value, and when to step back from the seductive pull of collective euphoria. History is a patient teacher, though its lessons are often learned too late. For every spectacular collapse, there are a few investors who navigate the turbulence and emerge not only unscathed, but enriched. Buffett's approach throughout decades of market cycles has been remarkably consistent. Focus on intrinsic value, understand what you are buying, and resist the seductive pull of the crowd. In the context of AI, this guidance takes on renewed significance. The technology is awe-inspiring, its potential enormous, yet the excitement that surrounds it can obscure the fundamental realities that determine whether an investment will endure or evaporate. Consider, for example, the case of investors during the dot-com bubble who adhered to sound principles. They sought companies with tangible earnings, clear business models, and realistic paths to profitability. When the speculative euphoria reached its peak, they were neither blinded by the hype nor compelled to chase astronomical valuations. Some of these investors initially missed out on the short-term gains, yet when the market corrected, they were positioned to capitalize on the survivors, companies that endured because their value was real, not imagined. Buffett's counsel emphasizes that patience is often more profitable than urgency, and that discernment is a skill cultivated over years, not days. The AI market today mirrors many of these dynamics. Startups are celebrated for breakthroughs in natural language processing, computer vision, and predictive analytics. Investors pour capital into firms that have yet to demonstrate consistent revenue streams or scalable profitability. Valuations soar, fueled not only by technological promise, but also by the fear of being left behind, a phenomenon that Buffett might recognize as the very human element that inflates bubbles. The tension arises when expectation detaches from execution. Companies may develop groundbreaking algorithms, yet their financial sustainability remains uncertain. Regulatory changes, competitive pressures, or technological limitations can turn rapid growth into sudden vulnerability. In such an environment, measured observation and disciplined reasoning become more valuable than intuition alone. Buffett's wisdom extends beyond financial metrics. It encompasses the temperament required to thrive in uncertainty. He has often remarked that investors would be better served by asking not whether a stock will go up in the short term, but whether the underlying enterprise has enduring value. This perspective is particularly relevant in the realm of AI, where headlines celebrate progress in months rather than years, and the collective imagination can inflate expectations to heights that reality may never reach. A disciplined investor asks, does this company produce sustainable earnings? Is the technology defensible? Can it adapt to regulatory scrutiny? How resilient is its business model in the face of competition? These questions, grounded in rational analysis rather than speculative thrill, form the bedrock of prudent decision-making. Let us examine the psychological forces at play more closely. Herd behavior is not merely a theoretical construct. It is a powerful driver of market dynamics. When investors see peers achieving extraordinary gains, they are tempted to follow suit, often without conducting independent analysis. Optimism becomes contagious, and skepticism is dismissed as timidity. In the case of AI, the sheer complexity of the technology compounds the effect. It is easier to trust the consensus, to assume that the experts and headlines know more than oneself, than to dig into the intricate realities of neural networks, data limitations, and deployment challenges. The result is a feedback loop. Enthusiasm fuels valuation, and valuation fuels further enthusiasm, pushing markets toward extremes that may ultimately be unsustainable. Yet Buffett's approach provides a blueprint for navigating this landscape. He emphasizes that market volatility is not inherently dangerous. Rather, the danger lies in misjudging intrinsic value and succumbing to emotional impulses. AI investments are exciting, but excitement without discipline is a precarious foundation. Investors who maintain a clear-eyed focus on fundamentals, who cultivate patience, and who separate speculation from value are better equipped to survive market turbulence and benefit from genuine innovation. In essence, the calm investor thrives not by predicting every technological breakthrough, but by understanding the principles that govern sustainable growth. There is also a temporal dimension to consider. Technology evolves rapidly, but financial resilience develops slowly. Many AI startups may falter in the short term, yet the innovations they introduce could shape industries for decades. The discerning investor recognizes that long-term value often emerges from patient observation and selective participation. The temptation to chase every headline, to participate in every trend, can lead to short-term exhilaration but long-term peril. Buffett's counsel consistently reminds us that wealth is preserved and built not through the thrill of immediacy, but through careful judgment, disciplined patience, and a steadfast commitment to understanding what we own. In this context, one cannot ignore the broader implications for the market. AI is not merely a sector, it is a catalyst for systemic change, influencing capital allocation, labor markets, and technological development. Yet systemic potential does not automatically confer intrinsic value on every participant in the market, just as not every internet company survived the dot-com bubble. Not every AI venture will endure the scrutiny of time and competition. The investor's challenge, therefore, is to discern which entities possess enduring value and which are ephemeral, thriving only in the glow of collective expectation. As we prepare to transition to the final part of our narrative, the focus narrows to reflection and perspective. The preceding discussion has traced the arc from historical bubbles to structural vulnerabilities, from psychological dynamics to Buffett's calm guidance. What remains is the synthesis, the practical application of wisdom in the face of excitement, the careful measurement of risk against potential, and the cultivation of a mindset that values patience over panic, clarity over hype. In the concluding section, we will draw these threads together, offering a reflective lens through which to view AI, its market, and the enduring principles that can guide prudent investing. The narrative tension, while sustained through risk and uncertainty, will resolve not with fear, but with understanding, allowing investors to navigate the AI frontier with both awareness and confidence. As we reach the final reflection on this unfolding story, it is worth taking a deep breath and stepping back from the immediate spectacle of AI, the soaring valuations, and the constant stream of headlines. The turbulence that excites and unnerves investors alike is not unique. It is a recurring feature of markets when human ambition meets technological promise. What distinguishes those who thrive from those who falter is not luck, but perspective. Buffett has long maintained that the key to long-term investing lies not in prediction, but in understanding, the disciplined evaluation of value, risk, and resilience. And in the context of AI, this perspective becomes both guidance and sanctuary amid the noise. We have explored the history of bubbles, from tulips to dot-coms, and seen the patterns that repeat across centuries: enthusiasm exceeding execution, expectation outpacing reality, and collective behavior amplifying risk. We have examined the structural vulnerabilities inherent in AI, from regulatory uncertainty to technological fragility, and recognized the subtle psychological currents, fear, greed, herd mentality, that drive markets beyond rational bounds. Yet in all this complexity, the underlying principle remains simple. True value is measured not in hype, but in enduring capability, in the ability to generate sustainable results despite volatility and unforeseen challenges. Consider again the river rushing toward the dam, the metaphor that captures the delicate balance between momentum and constraint. The water of excitement is powerful, capable of lifting even the most modest endeavors into prominence. Yet the dam of reality, profitability, regulation, technical limitations, and human judgment remains unyielding. Investors who understand the terrain, who chart the course carefully and respect the physics of finance, are the ones most likely to navigate safely. Those who ignore the dam, carried solely by the thrill of the current, risk being swept aside when the inevitable correction comes. The lesson is timeless. Markets may surge, but value persists only where it is grounded in substance. Buffett's wisdom reminds us that patience is more than a virtue. It is a practical tool for survival and success. In the face of AI's dazzling potential, the calm investor asks measured questions. Is this business capable of sustaining profits? Are its technologies defensible against competitors and regulation? Can it endure the inevitable cycles of hype and correction? By focusing on these fundamentals, one develops a compass that points steadily, even amid chaos. The investor who resists the gravitational pull of hype, who maintains discipline in valuation and judgment, is often rewarded not by fleeting headlines, but by lasting growth. At the same time, it is essential to acknowledge the transformative potential of AI. The technology promises to reshape industries, augment human intelligence, and create opportunities that were once unimaginable. Enthusiasm is not inherently dangerous. It is a signal of innovation and curiosity. The danger lies in allowing enthusiasm to override reason, in conflating excitement with enduring value. Investors can participate in this revolution, but only if they maintain clarity, temper expectation with analysis, and never lose sight of the fundamental principles that govern wealth creation over time. The narrative, when viewed in totality, reveals a delicate tension between possibility and prudence. AI is both thrilling and uncertain, promising and fragile, transformative yet prone to volatility. Investors are challenged to navigate this duality, balancing optimism with skepticism, imagination with discipline, and hope with awareness. In doing so, They not only protect their capital, but also cultivate a mindset capable of discerning genuine innovation from fleeting spectacle. Buffett's counsel is clear: focus on what is knowable, evaluate what is measurable, and respect the limits of human foresight. In other words, invest in substance, not in the myth of inevitability. Finally, let us return to the initial question that framed our exploration. Is AI a bubble larger than the dot-com era, or is it the dawn of a genuine technological revolution? The answer, like much in investing, is not absolute. It is context-dependent, grounded in perspective and prudence. Some companies will thrive, some will falter, and some will exist primarily as reflections of collective expectation. The role of the investor is to discern which is which, to participate where value is real, and to resist the siren call of speculation where it is not. In this measured approach lies the power to navigate uncertainty with confidence, clarity, and calm. As the dust settles on the frenetic narratives of headlines and hype, the principles endure: evaluate intrinsic worth, exercise patience, respect risk, and remain vigilant against the seductive pull of collective emotion. AI may be extraordinary, its potential vast, but wealth, like wisdom, is cultivated not in moments of excitement, but in the steady application of reason over time. Investors who heed these lessons, who temper curiosity with caution and ambition with discipline, will find themselves not at the mercy of market turbulence, but in command of their financial journey. And that, ultimately, is the reassurance Warren Buffett offers. The market may surge, technologies may astonish, but disciplined judgment, calm reasoning, and a long-term perspective remain the true foundations of enduring success.